What I want to talk about today are two business owners who recently started some very large whole life insurance policies. You'll see that the annual funding is about $2 million. Annual funding, $2 million, not $2 million over the life of the policy. That's how much they want to pay in per year. Their current plan is to fund the policies for about 10 years, which is how much? That's $20 million going into whole life insurance policies with the primary plan of using these policies for their business. Now, when you hear that, you may think, those are some pretty large dollar amounts there. That's well above what I'm considering, if you're considering a policy on the individual level. If you're on the corporate level, that might be right in line with what you're looking at. A lot of corporations practice similar strategies to that. But my point is, and the purpose of today's video, is as we go through this, we're going to see how the policies were set up, why they're interested in the policies, what questions came up. This way, you can see what people at a very high level are asking. This way, if you're considering a whole life insurance policy, you're equipped with these questions and some general knowledge so you know exactly what to ask and how a policy should be set up. And by the way, if you'd like the details on this specific case study, if you like numbers and Excel spreadsheets and you'd like to see the actual illustrations, I would check out the video above, as that provides a case study on this exact situation that we're discussing. So on the business owners, they have a company that is currently generating 8 figures in annual revenue. Whole life insurance, they're interested in policies. $2 million per year is what they want to fund, potentially a little bit more than that, but the policies are set up to be able to handle funding of $2 million per year for 10 years initially. So a question that comes up frequently is why? Why on earth would someone fund whole life insurance policies with $2 million per year? Here's the reason why. There's 2 primary reasons. A is the cash value. With a whole life insurance policy, especially if it's set up correctly, I'll talk about exactly what that means soon, but if it's set up correctly and with one of the top companies, it is a safe, liquid, and tax-free area to position money. Tax-free if we don't trigger a MEC or another taxable event. Cash value is what they're interested in though. And then secondly, using it as a line of credit. So a unique feature to a whole life insurance policy with respect to the cash value is that once I've got cash value in my policy, I can borrow against it while I continue to earn dividends and interest on my entire policy. So a quick example, you have $100,000 in cash value. You decide to borrow $50,000 against your policy. So you had 100, you borrowed 50. You've got $50,000 remaining in equity, another 50K you could borrow. However, you continue to earn dividends and interest still on the full $100,000. Now, to be fair, there is a cost to borrow the $50,000. So what's important to do is to analyze the actual growth rate or the dollar amount, how much am I receiving in total growth or total dollars from the insurance company on that $100,000? And then how much am I paying the insurance company in loan interest? And see, am I in the black or am I in the red? And I want to make sure that I'm not in the red, meaning make sure, Steve, I'm not paying more in loan interest than what I'm getting from the life insurance company. I hope that made sense. But point here is the line of credit feature is very appealing to them because they had expressed frustration in working with lenders over the years. I mentioned earlier, these two move fast. Anytime I reach out to them, they usually get back in 10 minutes. Sometimes I feel like it's 10 seconds. I even ask them, how do you guys get back so fast when you've got a company with multiple locations across the entire US? Like, how do you do it? They enjoy what they do and they're like, yeah, we are fast, we know it, but we thoroughly enjoy work. But my point is, they've been unhappy with banks, or they've expressed that frustration because banks can be slower than what they would like sometimes. So how they view it, if they can build up a big bucket of cash value and use it as their own source of financing, call it their own bank or their own banking system, that's what they're attracted in. So what we've got here are 2 business partners, one of which is very analytical, loves Excel spreadsheets, wants the details. When working with someone analytical, typically what's going to come up? I can be analytical myself, and right here, the drawback or drawbacks. What are some of the disadvantages to this, particularly for a business owner when the plan is to use the policy aggressively? So here it is. What I want to know with my policy, if I'm you, Mr. or Mrs. Client, is this. When we properly design this policy, we look at the growth. What's the actual growth? Meaning the internal rate of return, not the dividend rate, but the net IRR. And then also in dollars. You paid in X amount of dollars, but how much did you actually receive from the insurance company in total dividends and interest? And then how much did you pay them in loan interest? This is typically what people like to see, and it can be an area of confusion because the terminology in the industry is very confusing. I'll give you an example. If you look at a whole life insurance policy, you'll often see a dividend rate associated with that policy or with the company you select. A great example could be MassMutual. They presently have a dividend rate for 2023 of 6% flat. Many of their whole life insurance products currently have a variable loan interest rate of 5%. So you've got a dividend of 6% and a loan rate of 5%. 6% dividend, 5% loan rate. What crosses your mind when you hear that? For most, it's a positive 1% spread. Wait a minute, I can put my money in a whole life insurance policy, earn a 6% dividend, while I borrow against it only at 5%? I'm earning money. Why would everyone not do this? Very, very important to add clarity in this point. That 6% dividend does not equate to a 6% growth rate. Example, you have $100,000 in cash value, 6% would be $6,000. You will not see it grow by that much. A dividend rate with all whole life insurance products is always a gross rate that is applied to your policy after the cost of insurance and everything that comes with the life insurance policy. So in short, if I have a 6% dividend and $100,000 in cash value, I might see an internal rate of return, a net growth rate of, call it 4%, which is $4,000. So now all of a sudden, my net growth rate is $4,000. My cost to borrow is still 5%. What happened there? Now I've got a negative 1% spread. So with that in mind, that's one quick example here that's meant to provide clarity here or a potential drawback as to why people would not do this. Now, to simply see if this makes sense for you is to look at a policy and see how much it's growing by each year, then see how much you're going to pay in loan interest. If it's a policy with a fixed loan interest rate, that makes it much, much easier. But look at it on a yearly basis. And that's very, very easy to do. We've got case studies that go through that. If you're working with us, you likely have a workbook or you can request one from our company or your associate that allows you to plug your actual policy into the loan workbook so you can see the illustrated growth over time and then simulate loans you want to take and you can look at it side by side. It's pretty cool. But that's the potential drawback, specifically if I'm paying more in loan interest than what the policy is growing by. But awareness is key, and it's easy to provide that. So we did all that. What's another potential drawback that you might have if you're interested in a policy where you're funding $2 million per year? Let's assume you generate revenue of $10 million per year. So your annual revenue is $10 million. We can assume that you've got a 30% profit margin, so that's $3 million, and you can easily handle the $2 million. I think their profits are actually higher than that. They're very, very good at managing their company too. But my point is, let's say this is you, and you can easily handle this. Even if it's easy to handle right now, are you comfortable getting a $2 million bill every year for the next 10 years? How many people would say yes to that? Unless you've got $20 million already stored up in cash, that you don't need to generate any additional cash flow in order to move that $20 million into a policy. If that's the case, the answer is probably yes. But what happens to business companies in many cases? Revenue can fluctuate, especially when things outside of our control, such as the economy, go up and down. If there's economic downturn, we might have a couple years where we generate less in revenue. Now, some people can navigate through that storm and still generate positive cash flow. But my point is, do you want to commit to $2 million per year? I'll say about these two, they did not want to do that. So how the policies are set up is as follows. They've got 4 policies, but I'm just going to use one example here because they're all set up in a similar manner. they have a minimum commitment. This is referred to as the base premium of about $200,000 per year. It's slightly more than that, but that's their annual commitment. So how much do they want to pay in? Up to $2 million per year. How much are they actually billed for every year? $200,000 per year. So where's the other $1.8 million come from? Here's how it works. This is our PUA rider. PUA stands for Paid Up Additions Rider. And they actually went with one company. A lot of times you'll see situations like this. The individual or the company will diversify. They wanted one of the 4 major mutual companies and also a lot of flexibility. We can pay in about another $1.8 million per year for a total of $2 million. And these are ballpark numbers. The actual annual amount is actually a little bit higher than this, but we're just rounding off for this case. But here's the big thing with this. This is flexible. The policy is set up where they're only committed, again, to the minimum of $200,000, and they can add the rest at their discretion. So if they don't add $2 million per year, they're not penalized for it. Now, they would have less in cash value. The performance would be a bit weaker, meaning if I look at a policy where I'm max funded every year compared to a policy where I don't, if I haven't max funded, the performance will be a little bit weaker. Depends. And this is something we like to look at and analyze too before starting. But my point is it's flexible, so they're not obligated to pay that $2 million every year. Now, they think they can, they likely can when you look at their financials and such, but at the same time, that flexibility was very important. So to recap, what we'll see a lot of business owners and individuals do is set up a policy where it's very flexible, so I can fund a policy with the desired amount. How much do I want the ability to be able to add into a policy on any given year without being committed to that? So it's set up to be flexible, and then they could also use the policy as a line of credit as time passes. Let's use a smaller example and we'll close out with this. Let's say you want a policy where you want the ability to pay in $50,000 per year. However, you say, I do not want to get a bill for $50,000. I love the benefits of cash value life insurance. I understand how I can use it. Here's how much I want to be able to get into. But again, $50K per year scares me. So what you could do is set it up in a manner where your premium is $5,000 per year. That's what you're committed to. And you could get away with only paying that forever. Now, it won't look that good if you only paid the minimum. But my point is, here's what you're billed for. And then at your discretion, when I say at your discretion, the company selection is very important. All companies have different rules when it comes to flexibility. We can set it up here. We can add up to another $45,000 per year into your PUA rider. Now, it doesn't mean you have to add $50K every year. Maybe the first year it's 50, second year it's 10, then it's only 5,000 the next 2 years, then you go up to 30. Then you throw in 100,000 to make up for lost time. You can do that too. And you can adjust your funding as the years pass. So the flexibility is really the big thing. It was for them as far as getting money in, getting money out when it comes to loans and such. Again, if this is you, what I would look at is this. What's the policy look like from a growth rate standpoint? And we can look at growth based on the present dividend rate. If you like to look at things conservative, what I would look at then is the guaranteed values, which we've got videos and case studies that go through that. But look at it from a growth rate perspective and then compare that directly with the loan. And again, you can check out videos on our channel that actually go through the workbook or direct illustrations with the insurance carrier that model all of that. So I hope you enjoyed this video. I had a ton of fun with it. Let us know your thoughts below and if you have any questions. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.